Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I am your host. And so thankful to have you here with us today. We are continuing our series of walking through year by year Warren Buffett's annual letters to the shareholders of Berkshire Hathaway. Today, we're going to be going through a letter from 1970. And we've started back in 1965, working our way moving forward. And so excited about today's podcast. So we'll get into that in just a minute, but I also want to let you know a brief little announcement here that I've officially partnered again with Seeking Alpha to have another DIY investing summit, a mid-year DIY investing summit that will go live in late June. And so mark your calendars for, it should be June, the week of the 26th, probably most likely June 27th and 28th. It's going to be a smaller summit, a more focused summit. And I've gotten a lot of feedback from the last one, making a lot of improvements we're really excited about. So keep your ears peeled for more information about that, or you can always sign up at investorinthefamily.com for updates and things along those lines. And so keep in mind that's coming up. If you have any questions you'd love for me to ask contributors to the upcoming summit, email me, Brian, B-R-I-A-N, at investorinthefamily.com. That's Brian at investorinthefamily.com. And I look forward to hearing those updates as well. Something else that's also been on my mind has been digital currencies. And so depending on when you may or may not be listening to this, this is early June 2017, and there's recently been a really significant run-up in Bitcoin and Ethereum and a number of other digital currencies. And I know there's lots of mixed feelings about these currencies as far as whether they're some Ponzi scheme or whether they're a complete waste of time, a bubble with comparisons to tulips back in the day and all that kind of stuff. But I have a great interest in digital currencies. And if you do too, could you email me and let me know that? Because I'm really been considering doing a special series or some work on digital currencies like Bitcoin and Ethereum and Ripple and things like that. So shoot me an email. Again, Brian, B-R-I-A-N, at investorinthefamily.com. That's Brian at investorinthefamily.com. And let me know if you have interest in Bitcoin and other digital currencies, and if you'd like for me to spend a little bit of time focusing on that. Because as we go through Buffett's letters to shareholders, there are a lot of them, well over 50, and so I plan on doing them in sections. Maybe I'll do some for a while, then do a pause, and maybe do another series and come back, because I want to make sure it stays fresh and we get the most out of it as possible. And also they were able to address other timely subjects as well. So with all that being said, let's jump into the 1970 letter and pulling up my notes here. So again, this is actually the first letter that was actually signed by Warren Buffett. Brief, important note there. Some of you who are just following along through the podcast and not reading the letters yourself, you may not have noticed that the 1965 to 69 letters were all technically written by Warren Buffett, but signed by the management of, or the president of Berkshire Hathaway. But the 1970 letter is signed by Warren Buffett as the chairman of the board. So let's see, what did Buffett talk about in this letter? Well, he starts off by discussing really the very diverse earnings scene across the operations of Berkshire Hathaway. And again, give some reminder, some background on Berkshire Hathaway and kind of the journey we've been going down so far, is that Berkshire Hathaway started out as a textile company when Warren Buffett purchased it, and has seen, in the last several years, has seen lots of struggles in terms of just a really decline in the overall textile market and industry. And so Berkshire Hathaway has suffered along with that. And we've also seen that process. Berkshire Hathaway has begun to diversify their operations beyond just textiles. And so some of the lessons we've been pulling out of this bigger picture is that we want to take on the mindset of Warren Buffett and of how he built Berkshire Hathaway. And we want to see what can we learn as we look to build our own business. Because again, I'm putting out the philosophy that we are all business owners. Our household, whether you are single, married, or you have a family, your household is your business, okay? And how important it is to get our financial household in order, our personal finances in order, so that we can then be prepared to invest beyond ourselves. So then once we have our personal household in order, our personal finances in order, or our business in order, then we can look to, once we have excess capital, figure out how will we allocate that capital. Because again, I want to shatter the mindset that all of us, so many of us view investing as some kind of combination between E-Trade, Amazon, and Las Vegas. And we have this weird amalgam of things where we jump on this website, whatever your brokerage may be, we buy and sell companies sometimes on a whim. We may not feel like it is, but if we're honest, it is more often than we may want to think. And there's just all this confluence of major things coming together, but it's not seen as a major thing by enough of us. The severity and the significance of our investments is not felt in advance like I believe it needs to be. And so I, again, want to reshape our mindsets. We are allocators of capital. I want to use terminology beyond just investing because I want to kind of shift our mindset. We are allocators of capital. We buy businesses. We are business owners, okay? Your household is a business, so you are a business owner. And then when you have excess capital, aka you have extra money, once your debt is being managed in a healthy way, once you have a healthy amount of cash reserves for emergencies and operations and things like that, then once you have excess capital, that is capital you can allocate, aka invest in a whole variety of different options. So often we think public stocks or bonds or ETFs or mutual funds, and all those can be fantastic options, but they are just a few of many options available to us. All things we want to be exploring through this series and through some of the deeper trainings that I offer through Investor in the Family. But that's just a recap of, remember, the overall philosophy that we're working with here. And so as Buffett is beginning this letter, he's talking about as they've been diversifying Berkshire Hathaway beyond just the textile industry. They've bought an insurance operation, they've bought a banking operation, they've bought a newspaper and printing operation, and they've started a few different operations, but I'm getting ahead of myself a little bit. So again, Buffett begins the letter by giving an overall overview of the diverse results from the different operating practices. So for one thing, the bank had record earnings, and he has continued to praise the bank division of Berkshire Hathaway. Insurance has had some setbacks, but still has excellent returns. And textile has become more and more difficult. The textile operations has broken even, but still struggles. And so the main takeaway from all this is, again, highlighting the importance and value of diversifying. And you realize how, diversifying can be viewed a lot of different ways. Really, an important element of diversification is having non-correlated assets. So basically, you have assets that don't necessarily track alongside of each other. So, for example, this is perfect. You have textile industry, you have banking industry, and the insurance industry. Those are very different industries. Again, banking and insurance technically fall into financial services, but they're still very different industries as a whole between all of those. And so if the textile industry suffers, there's not really any direct correlation to the banking or the insurance industry. And so that way, if some of your operations suffer, you have others that can still be strong in light of that and not necessarily be dragged down by the other. That is an example of non-correlated assets and diversification. And this is just a great example of how Buffett and Berkshire have been pursuing just that. Overall, the annual returns for Berkshire Hathaway have been approximately 10%, which is far better than would have been the case if Berkshire Hathaway had remained exclusively devoted to the textile business. And this is part of where you start seeing the brilliance of Warren Buffett and how he managed Berkshire Hathaway come through. Because as they saw the textile industry struggling and they had some extra capital, they decided, we want to invest this capital where it will be treated the best, where it will have the most positive ongoing return for our company. And for a while, they put some of the money in publicly traded marketable securities and had some healthy returns there. And basically, that was like a holding cell as they're waiting for just the right acquisition opportunities, because they're always looking for what is a fantastic opportunity, but not investing until they find it, which is, again, a huge lesson for all of us. Don't ever be uncomfortable sitting on cash or sitting in quote unquote boring passive investments waiting for the right opportunity. And don't jump until you find something that you believe to be a fantastic opportunity. They are worth waiting for. And because Berkshire Hathaway has decided to invest outside of their textile industry, because they see the textile industry, their textile operations, and as they see the textile industry suffering, they decided, hey, let's see where our capital can be treated better outside of our existing operations. And again, that's where they bought the insurance company, the banking companies, and things like that. And so again, the lesson there is, so maybe your main income right now comes from your full-time job. That's going to be the case for almost all of us, or maybe 2 full-time jobs if there's a dual income family. But you need to think, well, but where can that excess capital best be invested? Is it investing in improving your standing at your current job? Is that starting a side business or investing in public markets or any number of other things? So again, because Buffett and Berkshire were willing to be creative and invest beyond just the textile operations, they have been able to see a healthy return of around 10% per year, which again is far better than would have been the case if they had just devoted their excess capital back into the textile business. So again, instead of investing into operations that were really suffering and kind of throwing money onto a sinking ship, they're looking elsewhere and they're seeing the fruit of that. Again, reinforces why strategic diversification can be so valuable. And so they continue to face strong headwinds in their textile operations, and they're actively working to make the most of the situation, which includes costly decisions to both Berkshire Hathaway and employees. So for me, what this is, again, is a challenge to think about, are we willing to make an honest assessment of our business or our household and make appropriate changes? For example, are there expenses that we need to cut? So do we need to take a step of faith and try to start a new income stream or something like that? So do we have an honest understanding and picture of where our personal finances, the health of our business, what is it? And are there changes that need to be made? Are there things that we're avoiding? Is there debt we're avoiding dealing with? Are there unhealthy spending habits that we're not paying attention to or don't want to deal with? And again, if we're married, that can be especially difficult within marriages as far as being able to have those discussions between husband and wife. But being willing to honestly address those things with yourself and in a very constructive, loving way, finding ways to have that conversation with your spouse. Side note, if that's something you're struggling with, send me an email because I actually would love to help with that as well. Again, Brian, Brian, at investorinthefamily.com. Just a little side note there, something I did not expect to bring up. But a very important thing and a very real thing for us to deal with as investors as we build out our businesses, but important to be honest with ourselves. So again, I could go into a lot more there. I'm going to say that for now. And let's move forward so that's a little bit look at the textile operations, which is kind of like always the womp, kind of like what's going wrong at textiles right now. Let's move into a little bit more exciting part of the letter with the insurance division. And, but first of all, as we're getting into insurance operations, we mentioned in previous years, that Berkshire Hathaway started a new insurance division. And again, I brought this up before, but it's important to say they emphasize the fact that it will take years before a real evaluation can be made about that new insurance division. So again, think about that. Now that is long-term thinking. So if you are considering starting a side business or some kind of alternative income stream, are you okay thinking, hey, you know what? It may be a few years before this really materializes. Because a lot of people, some of the most significant advice I give to new entrepreneurs is one, have a plan, and that plan may change 1,000 times, but have some plan to give you some focus and direction. Two, try to work on it and get better somehow every day if you can. Three, don't quit because everyone else does. And so I think, and this fits in with that, they have this new division they're starting, and it'll take several years before they know if it's actually profitable and worthwhile. And I encourage you to have the same mindset towards starting a business. But also other assets. If you're making a significant investment, it should be for the long term. There's so many illustrations of this I want to give. And one near term right now is I know some big news of late has been the fact that Warren Buffett and Berkshire Hathaway started purchasing shares of Apple. And Berkshire has always avoided technology companies, and Buffett has spoken, down on investments like that, at least for himself, because either he doesn't understand them or they're too complicated of a business. Not that he can't understand it, but he likes to keep things pretty simple, which I respect. But they started buying Apple. But here's the thing is, so they started buying Apple, and when that became public, everyone else thought, oh my gosh, I need to buy Apple. But here's the point I want to make with that is, when you look back on when they were buying Apple, they weren't buying Apple at lows, or all-time lows for the stock or any of that kind of stuff. It didn't necessarily seem like an amazing time to buy Apple. There wasn't like a big dip or something like that. And I'm sure they made purchases over a period of time as well. The point of that comment from me is the fact that, or that I want to make, is that great investments take time. And so if you're planning on holding Apple for 10 years or several decades, it doesn't matter. It's not that big of a deal if you buy it at $100 a share or $120 per share. I realize percentage-wise that can materialize to a significant difference over time. But the bottom line is, if you're expecting Apple someday to be worth $500 a share, buying it at $120 is still a good decision right? Just because you quote unquote missed it at 100 doesn't mean buying at 120 is no longer a good decision anymore. And I almost did a special episode. This is one of the reasons why I didn't have a podcast last week, is because I was going to contemplated doing a special episode on all of the stuff that's happening with digital currencies, with Bitcoin and Ethereum, because they're going through the roof in a very short period of time. And there were so many like case study illustrations that were coming out of that in terms of emotions that I was having, that I saw other people having. And it was a fascinating situation to watch how that affected my decision-making and the decision-making of those around me, and how quickly irrationality can ensue in those environments. It was awesome. But I ended up just not having time to put together the quality of a program that I wanted to, so I didn't do that. But I'm very seriously considering doing so. That's why I mentioned at the beginning of this podcast to email me if that is something of interest to you. So again, importance of being patient with our investments. So what if an investment loses money for 3 years, but then returns 20% or more for 10 years straight? Would that be worth the wait? I'm thinking most of us would say yes. So again, things to remember as we're developing and solidifying our investment philosophy. Then he goes off to talk about his surety business that's tied to the insurance businesses, and how it operated at a significant underwriting loss, and how the contractor's bond field was a disappointment. And so basically this is one of the pieces within the insurance operations that was a disappointment. And this is a nice, hopefully encouraging reminder for all of us that even Buffett and Berkshire Hathaway make investments that don't appear to work out. So nobody is perfect at this. Like I mentioned a few weeks ago, no one knows with absolute certainty what the future holds. And even that is probably too bold of a statement in terms of really none of us know what tomorrow holds or an hour from now holds. So when we're talking about investing, we're trying to make predictions about the future, which on one hand is inherently impossible. And so it's important to remember the reality of the task we have at hand. And so what we want to do is figure out how can we use wisdom to make decisions, responsible decisions about the future. That's what we're trying to do. And inevitably we're going to make decisions that don't work out like we want to, and that's okay. We need to show ourselves grace, show ourselves forgiveness, and allow ourselves forgiveness when we make mistakes. And remember, Berkshire and Buffett have made mistakes as well. It's okay. We just want our wins to hopefully significantly outweigh our losses, right? But another thing is they launched a new business or subsidiary out of the National Indemnity, which was their insurance operation, and a plan to open a new one in 1971. So this is a new thing for Berkshire within the time period we've been following them. We've seen them, we've seen them make full-on acquisitions of other companies. We've seen them invest in marketable securities or common stocks, but they've said they're not going to do that anymore. But they did it for a few years successfully. Now we're seeing them start new businesses. And so we see Berkshire looking at what are different ways we can invest capital. Again, buying businesses, starting new businesses, investing in public markets. So again, I want to challenge us. What options are on the table for you and for me that we're not currently thinking about or we don't think are possible? I guarantee you far more things are possible than you and I may realize, but we just don't think about them. We don't realize them, or we just automatically rule them out because it seems complicated or beyond us. But I assure you there's a lot more available than you and I may think. And again, these are things I want to elaborate more through future trainings and stuff than beyond just this podcast. But I want us to have that mindset, just the open-minded aspect of what else is out there. You know, are there investments in local businesses that can be made? And again, all this stuff needs to be done with proper due diligence and responsibly. I'm not saying do anything that I'm not telling you to do anything. I mean, letting you know what options are out there. You know, we all need to take personal responsibility for our investments. But, you know, are there investments in the community? Are there investments, crowdfunding investments? Are there, starting funds? Are there different options that can be purchased or created locally with different businesses or different opportunities? There's so many things that are possibly out there. And again, never enter into something you don't fully understand. You don't do your own due diligence. I just want us to think beyond, hey, what stock can I buy today or this year? And again, that may end up being the best decision, but you understand what I'm saying. Having an open mind. And another thing I want to bring up is that how quick Buffett is to celebrate his operational managers and give them credit. He specifically, by name, highlights managers from the textile operations, from insurance operations, and banking operations, and talks about how amazing they are. And it's so important for us to remember strong management is central to Buffett's acquisition philosophy. So it begs the question, am I surrounding ourselves with people smarter than we are? Okay. This could mean an investment advisor. This could mean a newsletter or an investing service. And just acknowledging the fact that we want to hire amazing people to help manage our business, right? To help manage our operations. We don't have to manage all of our operations ourselves. We don't have to do all the research on our own to fill an entire portfolio of stocks. We can do like Buffett did and focus on who are great managers that we can hire to handle our operations for us. So are we trusting our capital to people smarter than we are? Are we humble enough to admit and act on this? Are we humble enough to admit that maybe we aren't the best people to manage all of our capital? And so maybe our primary job, or I'll say our primary job, is to figure out who do we quote unquote hire to manage our capital for us. And again, that may mean paying for an annual newsletter. On an annual basis, but an ongoing regular newsletter that can help guide us in our portfolio decisions, or any number of other things, maybe hiring a mentor, maybe hiring an investment advisor. Again, so many different options like that. So here's a bonus question that none of us probably want to hear or think about, but would you hire yourself to manage your business? Based upon your current track record of how you're managing your household and how you have been making decisions as an investor of your own capital, if all things being equal, if you were looking to hire someone to manage your portfolio or to manage your business, would you hire yourself? And be honest about that. And if the answer is no, why? Why would you not hire yourself? What changes need to be made? And what will you do to make those changes? What outside help do you need, and what will you do to get that help? Let's be honest with ourselves about these things, because with that honesty comes the ability to grow and see significant change. So many of us, we can be we're actually stubborn/fearful. We're fearful of acknowledging the fact that, you know what, I'm not doing a good job of managing my household financially or otherwise, and I'm not doing a good job of allocating capital and managing my investments. But we're afraid to admit that because we don't want to admit we've been making mistakes, we've been hurting our family financially, and we've been losing money and underperforming and so on. We don't want to admit that because it's painful to admit it. But here's the deal. We have to come to grips with reality and admit the truth, because until we do, things won't get better. And things have to get better if you're in that situation. Even if you're doing really well, things can still get better. And so there's always room to grow for all of us. None of us are perfect, and we won't be perfect, but we can always improve. And that's what we need to focus and work on. And also an honest assessment of if we have other managers of our assets or our business or our investments, how are they performing? Do we need to fire them and hire someone new? All things to consider as we're thinking through this process. And so again, as we've gone through the 1970 letter, lots of reinforcement of themes from the last few weeks, from the 65 to letters up till now. And again, I want to remind all of us that the repetition is crucial and important because we are forming a philosophy of investing, a new mindset and thinking toward all of these things. And that's one of the reasons why I'm intentionally not fast forwarding through some of these letters that may seem like, hey, this doesn't sound exciting, it doesn't sound new. That's intentional because it's shaping our thinking, and the repetition is important. And each week there's new things coming out through all of them as a whole anyway. But I am thoroughly enjoying this series, and I'm loving the feedback I'm getting from you. Please always feel free to reach out to me at Brian, Brian, at investorinthefamily.com. Would love to hear from you with any thoughts on this series, this episode, or the podcast. A few things I mentioned specifically, if you have any interest in digital currencies, if you have any interest in the upcoming investing summit later in June, or if you have you're having a hard time with financial conversations internally within your household with your spouse or children, those are all topics you can shoot me an email about. Would love to discuss more. And again, thanks so much for joining us today. We'll look forward to talking to you soon. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.